For 9 straight years, one hedge fund strategy returned about 12.8% a year. 9 years, one losing year in the entire run, and that loss was just 4.4%. No 3-year stretch worse than 8.3% annualized. Wall Street called it the model absolute return strategy. Money, apparently, without market risk. Then in 4 months it broke. And the reason it broke is the same reason it worked. So what is convertible arbitrage? A convertible bond is a bond that can be swapped for a fixed number of the company's shares. That makes it 2 things at once. It is a loan, paying interest, ranking ahead of the stock if things go wrong. And it is an option on the stock rising. The arbitrageur buys the bond and sells short some of those shares. Not all of them. Oh, get that ratio right and something elegant happens. If the stock rises, the short position loses, but the bond gains almost as much. If the stock falls, the short gains, and the bond falls by much less, because a bond is still owed its money back at maturity. Heads, you make a little. Tails, you make more. Add leverage, and a steady drip of small profits becomes a double-digit return. That is the promise. And here's the wedge that makes it work at all. You are not really betting on the company. You are buying the option buried inside the bond and hoping you bought it cheap. To understand why it died, you have to understand why it was ever profitable. Go back to the 1970s. Convertible bonds were a backwater. Companies that could not raise money cleanly issued them, and few investors wanted them. Being unloved, they were cheap. And that cheapness was the entire edge. If you could buy a convertible for less than the bond and the option were worth separately, you could hedge the stock out and simply collect the difference. Then the mathematicians arrived. Ed Thorpe, a mathematics professor who had already written the book on beating blackjack by counting cards, turned the same machinery on convertibles. He worked out how many shares to short against each bond. That number is called the hedge ratio, and it is the heart of the trade. Short too few shares and you are secretly betting the stock rises. Short too many and you are betting it falls. Get it right and you are betting on neither. You are betting on movement itself. Now, this worked beautifully as long as a few dozen sharp people were doing it against a market of thousands of ordinary buyers. They could dart in, pick off the mispricings, and leave. Through the late 90s, the record was extraordinary. So, of course, money noticed. Here's the machine, 1 block at a time. Block 1. What you are actually buying. Take a bond convertible into 40 shares, with the stock at $20. The shares underneath are worth $800, but the bond does not trade at $800. It trades at, say, $1,000. That extra $200, 25% of the conversion value, is the conversion premium. What are you paying for? An option, the right to the upside without the full downside, plus interest along the way, plus a claim that ranks ahead of the stock. So when you buy a convertible and hedge the stock out, what you are left holding is an option, and options are priced off volatility. This is the back door. You are not buying a bond, you are buying volatility, wrapped in a bond from a company that mostly wanted cheap financing and did not think very hard about what the option was worth. Block 2. Why cheapness is the whole game. Notice that nothing in this trade generates a profit by itself. The hedge cancels out the direction. The interest is small. The entire return depends on having bought the option for less than it turns out to be worth. If the convertible is fairly priced, the strategy returns roughly nothing after costs. If it is expensive, the strategy loses. The edge is not the technique. The edge is the discount. And the discount existed for exactly one reason. Nobody else wanted these bonds. Block 3. Now watch what money does to that. Returns are excellent, so capital arrives. Capital arrives, so arbitrageurs buy convertibles. Their buying lifts convertible prices relative to the stocks, which makes existing positions look even better, which attracts more capital. This is a virtuous cycle, and it is genuinely virtuous right up until it isn't. Because every dollar of that buying is spending down the exact thing that made the trade work. But cheapness. By 2004, at times an estimated 80% of all convertible buying came from arbitrageurs. Read that again. The people whose entire edge was buying from a market that mispriced these bonds had become the market. They were no longer picking off other people's mistakes. They were setting the price, and they would buy almost anything, because they did not care about the company. They only wanted the position on. The strategy had eaten its own food supply. Block 4. What followed was arithmetic, not bad luck. In 2004, the index returned 2.0%. Not a disaster, just the sound of an edge disappearing. And here is the turn. A crowded trade does not only earn less, it becomes dangerous in a way an uncrowded trade never is, because everyone in it owns the same thing, and everyone will want out through the same door on the same day. May 2005 is what that looks like. The most crowded position in the business was General Motors. The logic was beautiful. Be long General Motors debt, short General Motors stock. If the company was in trouble, and everyone could see that it was, the stock should fall much harder than the bonds. You were not betting on the direction of anything. You were protected either way. What could go wrong? On the 4th of May, Kirk Kerkorian announced he intended to bid $31 a share for 28 million shares of General Motors stock. The stock jumped from roughly $28 to $32. Every arbitrager short that stock took a loss. The next day, the 5th of May, Standard & Poor's downgraded General Motors' credit rating. The bonds fell. Every arbitrager long that debt took a second loss. Both legs of a hedged position lost money on consecutive days. The thing that could not happen happened, and then the door got crowded. Investors had already pulled $1.7 billion out in the last quarter of 2004 and another $1.8 billion in the first quarter of 2005. Now redemptions accelerated, and redemptions in a leveraged strategy mean forced selling. Forced selling pushed convertible prices down. Lower prices meant bigger losses. Bigger losses meant more redemptions. The virtuous cycle was running in reverse at speed. Through April, the index was down 5.8% on the year. April alone was the 5th worst month out of the previous 136. The index had fallen in only 14 of the 108 months from 95 through 2003. It fell in 9 of the 12 months to April 2005. 4 consecutive down months. That had never happened before. May made it 5. So the lesson is not that convertible arbitrage was a bad idea. It was a good idea. That was the problem. Every strategy that earns money by correcting a mispricing is spending that mispricing as it goes. The return and the destruction of the return are the same act, which means the question to ask about any strategy is never only, does it work? It is, how much money is already doing this and how much room is left. Howard Marks wrote at the time that the returns available from a strategy are not independent of the amount of money chasing it. And notice what happened next. By the time everyone had left, convertibles were cheap again, and the trade worked again. Which brings us to now. 2025 was the largest year for convertible issuance on record in dollar terms. $166.5 billion globally, just under the 2001 record of $166.7 billion. The convertible index returned 23.3%. Much of that new supply is coming from companies financing artificial intelligence infrastructure. New issuance means new options to price. That is the supply side. The question this framework asks is about the other side. Not, are convertibles attractive, but how crowded is the boat this time? That is a lens, not a signal. More breakdowns of the machinery under the market on this channel.